Okay, so the last thing we want to talk about in Chapter 5 are the adjusting and closing entries. Almost everything is the same as what we did in Chapters 3 and 4. Even if we're doing, even with a perpetual inventory system, we still need to do a physical count. We just don't do it as often. Physical count. This is due to what we call inventory shrinkage. So this could be the loss of inventory due to threat, or I'm sorry, due to shoplifting or employee theft, or even just damaging. But at some point, we record the inventory into merchandise inventory when we buy it, and it goes out when we sell it. But there is times where things disappeared and we didn't sell them. Again, theft, loss, or sometimes just damage, or if it's perishable goods, things might have just gone bad and we had to throw them out. So for those reasons, our inventory balance might not match what our account says, because some of the stuff didn't get sold, but it's not here anymore. So the amount of this adjusting entry, and we probably just do a physical count maybe once a year and do this adjustment, but the amount of it will be the balance in the merchandise inventory account. So what's in that ledger account minus the actual inventory on hand. And that's what we get from doing a physical count of the inventory. And so once we determine that amount, the adjusting entry is just a debit to cost of goods sold and a credit to merchandise inventory for the amount that we got right here. So by crediting merchandise inventory, that asset, it'll bring the balance down, so it'll match what we physically have. It's very similar to the adjusting entry we did for supplies in Chapter 3, where we need the account to match what we actually have. As far as the closing entries, the process is exactly the same, except we have a couple new temporary accounts that need to be closed in that process. We have sales, returns, and allowances. We have sales discounts, and we have cost of goods sold. So the process is the same, we just have a couple, and delivery expense, that's kind of a new one, but that's just treated like any other expense, as is cost of goods sold. So just to show you here what that one looks like, we have sales revenue instead of service revenue, but the first step in closing entries is exactly the same. We close the revenues to income summary. Then the second step is we close the expenses to income summary. So you can see cost of goods sold and delivery expense. Those all have debit balances, so we need to credit those. So we debit income summary. And then sales returns and allowances and sales discounts, those also have debit balances. So those will go in here with step 2, where since they have debit balances, we will credit them and debit income summary. And then step 3 and 4 are exactly the same as they were in Chapter 4. There's no difference there. And here's one just to do a practice on the adjusting entry for this inventory shrinkage. So the account balance in the merchandise inventory account is $62,000. But when we do a physical count of what's on hand, we get $60,800. So the difference here, the amount to be adjusted is the difference, and that's $1,200. So the journal entry to do that is just a debit to cost of goods sold for $1,200 and a credit to merchandise inventory for $1,200. And then that's the only extra adjusting entry that we'll need. Other than that, the adjusting and closing process is exactly the same as it was for the service businesses we've done before. And then the last thing I want to talk about here is the financial statements. And really the only one that's a little bit different is the income statement, because we are now going to do, for a merchandiser, we're going to do a multi-step income statement. So it's still revenues and expenses, just like we had. We just have a couple new accounts and new subtotals. So we'll have gross profit. We talked about that. That will be the revenue minus the cost of goods sold. So we'll need to see that one. It'll give us a little more information. So that's why we do it this way. We'll break down the other expenses into a couple categories. So we'll have selling expenses, which will be anything related to marketing and selling. So marketing and selling, like sales commissions or things like that, including selling in the store. We'll have administrative expenses, and sometimes you see selling and administrative together expenses. So these are not related to selling. So this would be office stuff, or like if you have a CEO's salary or insurance on the building, not related to selling. So I'll show you some examples here in a second. And then sometimes we have other revenue and expenses. So this might be revenue that I'm earning from renting out a building, or interest revenue, or interest expenses, things like that that are kind of related to other things, not my actual store activities. And then the statement of owner's equity. I don't know why it keeps doing that. Statement of owner's equity and the balance sheet. There are no changes. Those are exactly the same as we did them. The only difference is that you've got an extra asset, current asset in here now with the merchandise inventory. So here is a multi-step income. And so we can see the revenue minus sales returns and allowances gives us net sales revenue, minus cost of goods sold gives us gross profit. So that's our first important point. Then we take all of our operating expenses and we break those into selling, administrative, and then sometimes you get some other things here. So total selling expenses are things like salaries, rent on my building, advertising. This would be depreciation on anything related to the store, delivery expense. So here's my total selling expenses. Utilities, administrative or other things not related to selling. So this might be depreciation expense on the trucks that I used to deliver or something like that, or on the store fixture stuff, but it is related to the selling my product. Then here I've got utilities and salaries and insurance and rent and things not related to selling, so those go here. So then the selling and administrative together are my total operating expenses. So now I take my gross profit minus my operating expenses, gives me operating income. So gross profit minus my operating expenses gives me my operating income. Then these are things that are not related to my store. So I've got some interest expense. Sometimes I have interest revenue here, but these are not related to my primary business, whatever that business is. And so there's still my net income. So it's still revenue minus expenses. I just have some additional subtotals and I break them into some additional categories here. And it gives the managers a little bit more information about where their expenses lie and where they maybe need to make some adjustments. For instance, if your other revenue is really high, it could be masking the fact that your business is not doing that great. The only reason you have a decent net income is because you've got a lot of interest income from your investments. Well, then your store's not really doing that well, and so we don't want to just lump it all together, because then we don't have as much information to make decisions. So the last one here, there's a couple problems here. They want you to do an income statement using the multi-step, and then a statement of owner's equity and a balance sheet for here. So income statement things, let's make those yellow. So income statement will be my revenue and my expenses, right? So I've got selling expenses, I'll have administrative expenses, sales returns and allowances goes on there. Think of that as part of sales. Cost of goods sold, sales revenue, interest expense, and sales discounts. Those will all go on the income statement. And then the statement of owner's equity will be, we'll start with the capital account. We'll give them the net income, and I don't see any withdrawals on here. So then the rest of this should go on the balance sheet. So we'll have, this is an asset, liability, liability, asset, asset, liability, and asset. So those will go on the balance sheet. So rather than try and write it in my messy handwriting, here's what we'll have. So for the revenue, we have our revenue. Let's go back. We have our revenue here, minus sales returns and allowances, minus discounts. That gives me my net sales revenue. Minus my cost of goods sold gives me my gross profits. That's my first important number. Then on this one, they just lumped all the selling expenses together and then all the administrative expenses together. So that gives me my operating expenses are the sum of these two right here. And so then gross profit minus operating gives me my operating income. Then I have one other expense, so I subtract that off, and that's my total net income. So the operating income is just how the store is doing on its own. Then there's absolutely no difference here on the statement of owner's equity from what we have done before. This is my beginning capital, plus this is the net income from the income statement. That gives me this subtotal. There's no withdrawals, and so that's my ending capital balance from income statement. Now that I have the new capital balance, this is what I will use on the balance sheet. Hopefully this is nothing new because we've done a bunch of these. And so here's my balance sheet. So my current assets are up here, cash, accounts receivable, and merchandise inventory. So here's my total current assets. And then my plant assets, even though this isn't a plant, we still call them that, but those are my long-term assets here. So here's my total assets. Liabilities, the current liabilities are accounts payable and accrued liabilities. So here's my total current liabilities plus my long-term liabilities. So here's my total liabilities. Then this is from the statement of owner's equity, the new one that I just did, owner's equity. And so now my liabilities plus my owner's equity together equals this, and these two here equal total assets equal total liabilities plus owner's equity. So nothing new in the balance sheet, nothing new in the statement of owner's equity. The only difference is in the multi-step income statement is breaking them into categories. And so if you follow this pattern right here, you shouldn't have any trouble. So that's the rest of Chapter 5.